We have seen the vertical climb. Now we must look at the structural forces, monetary and geopolitical, that built the foundation for this fever. What I'm going to cover is not financial advice. It's for education purpose only. I try to help you get a better picture of the situation and avoid FOMOing into a trap. The current silver rally didn't emerge from a vacuum. It's the product of multiple structural forces converging simultaneously. Understanding these forces is essential to assessing whether current prices represent fair value or speculation. Let's start with the monetary policy. The Federal Reserve began cutting rates in late 2024 after maintaining restrictive policy for nearly 2 years. That pivot triggered a global reassessment of real yields. When real interest rates fall, non-yielding assets like precious metals become relatively more attractive. The mathematics are straightforward. But monetary policy alone doesn't explain a 190% rally. The supply side tells a more compelling story. Global silver production has been in deficit for 5 consecutive years. That's 820 million ounces of cumulative shortfall. Mine output peaked in 2016. It hasn't recovered despite higher prices. Why? Did you know that 70% of silver is mined as a byproduct of copper, zinc, and lead? That means that even if silver hits $200, miners cannot simply turn on the taps if base metal demand is lagging. When base metal prices weaken, silver production falls regardless of silver's own price. This creates persistent supply rigidity that amplifies price moves in both directions. Then came the reclassification. In September 2025, China designated silver as a strategic resource. The implications were immediate. Export quota tightened, domestic refiners prioritized local buyers, international supply chains fractured. What was a chronic deficit becomes an acute shortage. The geopolitical dimension matters. China controls roughly 60 to 70% of global refined silver production. When they restrict exports, physical markets fragment, prices in different regions begin to diverge. Premiums explode. The global price discovery mechanism breaks down. This creates the perfect environment for speculation. Physical scarcity drives one narrative. Monetary policy drives another. Geopolitical tension drives a third. Each story reinforces the others. The reflexivity builds on itself. Industrial demand adds another layer. The solar energy transition requires massive amounts of silver for photovoltaic cells. Electric vehicles use more silver per unit than internal combustion engines, but the real demand surge comes from artificial intelligence infrastructure. Modern AI server farms require substantially more silver than traditional data centers. The thermal management system alone uses 2 to 3 times more conductive materials. As AI deployment accelerates, industrial silver consumption has grown from 45% of total demand to 55% in just 3 years. This creates a narrative of structural undersupply. The market believes industrial users will bid at any price to secure supply. The currency dimension completes the picture. Central banks have been diversifying away from dollar-denominated assets at record pace. Gold purchases exceeded 1,000 tons annually for 3 consecutive years. Silver benefits from this rotation, even though central banks don't hold silver as a reserve asset. The logic is associative rather than direct. What we have is a perfect storm. Monetary easing, structural deficits, export restrictions, industrial acceleration, currency diversification. Each factor is real. Each factor is measurable. But the question isn't whether these forces exist. The question is whether they justify current prices or whether speculation has decoupled price from fundamentals. With the macro stage set, we need to look at the trap. The mechanics of futures trading create invisible risk that only become apparent during periods of extreme volatility. These risks have nothing to do with market direction. They are structural. built into the architecture of leveraged markets, and they've already started claiming victims. In late December 2025, the CME Group raised initial margin requirements for silver futures from $12,000 per contract to $25,000 per contract. That's more than a doubling overnight. For traders running leveraged positions, this created an immediate crisis. The data shows the impact. In the 3 days following the margin increase, silver futures open interest dropped by 15%. That's not natural profit taking. That's forced unwinding. Thousands of retail traders were pushed out of positions, not because their market view was wrong, but because they couldn't meet the cash call. Here's how the trap works. A silver future contract represents 5,000 ounces. At $50 per ounce, that's $250,000 of notional exposure, but traders don't post the full amount. They post margin. Before December, that margin was $12,000, so traders were running roughly 20-to-1 leverage. When margin requirement doubled, traders had two options: post additional capital immediately or liquidate positions. Many couldn't post the capital. They were already fully invested. Some were using accounts that didn't have additional funds available. The result was forced liquidation. This is where the escalation begins. Forced selling pushes prices down. Lower prices trigger stop-loss orders from other traders. Those stops create more selling pressure. The feedback loop accelerates. What started as a margin adjustment becomes a cascading liquidation event. The CME's decision wasn't arbitrary. Exchanges raise margins when volatility increases. It's a risk management function. They're protecting the clearinghouse from trader defaults. The effect is procyclical. Margins rise exactly when traders are most leveraged and least able to meet calls. For retail traders, this creates asymmetric risk. On the way up, leverage amplifies gains. A 10% move in silver becomes a 200% gain on margin. That's intoxicating. But on the way down, the same leverage works in reverse. And now there's the added risk of forced liquidation before any recovery can occur. Professional traders understand this dynamic. They maintain cash buffers specifically for margin calls. They size positions knowing requirements can double without notice. They treat margin not as maximum leverage, but as minimum safety. Retail traders rarely have this discipline. The silver market is particularly vulnerable to this dynamic because it's smaller than gold or major currency pairs. Lower liquidity means wider spreads during stress. A market sell order that would move gold by 50 cents can move silver by $2. For leveraged traders, that difference is catastrophic. This has already happened. Multiple retail brokers issued statements in early January explaining how clients ended up with negative balances. Leverage that enhances gains on the way up creates existential risk on the way down. Professional risk management starts with position sizing. Never risk more than 2% of capital on a single trade. Never use more than 3-to-1 leverage in commodities. Always maintain cash reserves equal to initial margin times active positions. These aren't suggestions, they are requirements for survival. Retail traders who entered silver in December expecting the rally to continue have been systematically flushed out, not because silver crashed, but because the structural mechanics of leveraged markets made their positions untenable. Understanding this risk is essential before considering entry. Margin calls are forcing paper hands out, but this is creating a bizarre fracture between the digital code and the physical metal. One of the most striking features of the current silver market is the extreme divergence between paper prices and physical availability. This fragmentation reveals important information about market structure and highlights specific risks for different types of investors. The spot price of silver, as quoted on exchanges like COMEX, recently traded over $80 per ounce. This is the paper price. It represents contracts for future delivery. The vast majority of these contracts are settled in cash. Physical delivery is rare. The paper market is primarily a price discovery and hedging mechanism. But in physical markets, the story is completely different. Retail bullion dealers in Dubai reported prices of $130 per ounce for immediate delivery in early January. In India, physical silver reached similar levels. These aren't outliers, they represent a persistent premium of 70 to 85% above the paper spot price. How is this possible? In efficient markets, arbitrage should close such gaps almost immediately. If physical silver trades at $130 while paper silver trades at $80, traders should buy paper and sell physical until prices converge. The fact that this arbitrage isn't happening tells us the markets are fractured. The primary cause is China export restrictions. As a strategic resource, silver leaving China requires government approval. That approval has become increasingly difficult to obtain. Chinese refiners prioritize domestic buyers, international purchases face quotas and delays. The global supply chain has effectively fragmented into regional markets. This creates what economists call a two-tier market structure. Professional traders and institutions can access paper silver through futures and ETFs at the official spot price. But retail investors trying to take physical possession face massive premiums. The same asset trades at fundamentally different prices, depending on who buying and in what form. For investors, this creates a critical decision point. Do you buy paper exposure through ETFs and futures at $80? Or do you pay the premium for physical metal? The answer depends entirely on your objectives and risk tolerance. Paper silver offers immediate liquidity. You can enter and exit positions within seconds. Spreads are tight. Transaction costs are minimal. But you are exposed to counterparty risk. ETFs hold metal on your behalf. Futures are contracts for delivery. You don't control the physical asset. During a crisis, that distinction could matter enormously. Physical silver eliminates counterparty risk. You hold the asset directly. No intermediary can restrict your access. But you pay a massive premium for that security. At current levels, you're paying 85% or even more than paper prices. You are also accepting illiquidity. Selling physical silver back to dealers often involves additional discounts. The premium itself contains important information. An 85% physical premium suggests extreme scarcity in retail channels. This 85% premium is the panic tax we teased earlier. Retail investors are so desperate for physical security that they are paying a price that assumes the financial system has already collapsed. Retail investors are paying any price to secure metal. This is classic late-stage bull market or Wyckoff buying climax behavior. Professionals sell scarcity. Retail buys it. Here's the risk. If the paper market corrects, physical premium typically collapse. The premium exists because retail investors believe paper markets will fall or supplies will become unavailable. If silver drops from $80 to $50, that fear dissipates. Premiums that were 85% can fall to 20% overnight. This has historical precedent. In 2011, physical silver premiums reached 40% above spot during the peak of that rally. Within 3 months, premiums had returned to 5%. Investors who bought physical at the peak suffered dual losses. The metal declined in value and the scarcity premium evaporated. For those considering physical silver, the question becomes whether the 85% premium is insurance or speculation. If you believe the financial system will fail and paper assets will become worthless, the premium might be justified. If you're simply trying to gain exposure to silver's price appreciation, you're probably overpaying dramatically. The mathematical reality is stark. Physical silver needs to rally to nearly $170 just for you to break even with someone who bought paper silver at $80 and takes a 20% premium when they eventually convert to physical. That's not investment, that's betting on apocalypse. If the panic tax is the emotional driver, AI is the fundamental engine. But is the AI story also being overbought? The industrial demand narrative has become central on the bullish case for silver. Unlike gold, silver is consumed in manufacturing. Once used, most of it isn't recovered. This industrial dynamic creates genuine supply constraints, but it also creates risks that aren't immediately obvious. The data on AI infrastructure is compelling. Server motherboards designed for AI chips use 2 to 3 times more silver per unit. The thermal management systems use silver-based conductors because of the metal's superior heat dissipation properties. Modern data centers built for artificial intelligence workloads thus require substantially more silver than traditional facilities. As AI deployment accelerates, this creates measurable demand growth. Industrial silver consumption has risen from 45% of total demand 3 years ago to 55% today. The 10% point shift represents roughly 150 million ounces annually. It's real, it's structural, and is likely to continue. Solar panels add to the equation. Each panel requires roughly 20 grams of silver for the conductive paste used in cell construction. Global solar installations have been growing at 20% annually. That translates to approximately 100 million additional ounces of silver demand each year. Electrical vehicle adoption contributes as well. EVs use more silver than internal combustion vehicles for electric motors, battery management systems, and charging infrastructure. The growth is measurable, but smaller than AI and solar, perhaps 30 million ounces annually at current adoption rates. Add these together, you have genuine structural demand of roughly 300 million ounces per year. With total annual silver supply around 1 billion ounces, this demand growth is material. It's not speculative, it's already showing up in consumption data. But here's where the narrative becomes problematic. Industrial users are price sensitive. They have budgets, they have substitutes, and they have the ability to redesign products when input costs rise beyond economic thresholds. Silver at $30 per ounce is one equation. Silver at $80 is completely different. Manufacturers are already responding. Several major solar panel producers have announced research into copper-based conductive paste. These alternatives aren't as efficient as silver, but at current price differentials, they're economically viable. A panel that's 2% less efficient but 30% cheaper on materials is an attractive trade-off. The AI server market is showing similar dynamics. Engineering teams are exploring alternative thermal management solutions. Some are increasing copper content, others are redesigning heatsink geometries to require less conductive material overall. These changes take time to implement, but the R&D is already underway. This is the industrial bottleneck problem. Higher silver prices incentivize the very demand destruction that undermines the bullish thesis. Unlike monetary demand, which can remain irrational indefinitely, industrial demand responds to economics. When the math stops working, orders decline. Historical data supports this concern. In 2011, when silver briefly touched $50, industrial demand declined for 3 consecutive quarters. Users drew down inventory. They delayed projects. They substituted where possible. Demand didn't collapse, but it stopped growing. That's all it takes to shift market dynamics. The current situation is more extreme. Industrial buyers are facing unprecedented cost pressures. Some are hedging future requirements through long-term contracts, but many are simply reducing consumption. There's a reflexivity to consider. As long as prices keep rising, industrial users panic and buy forward. Their buying supports prices, but there's a limit. Once buyers have secured 6 to 12 months of supply, their purchases stop. The demand that supported the rally disappears even if the fundamental use case remains intact. The inventory cycle matters. Industrial users who bought aggressively in December will work through that inventory over the first half of 2026. During that period, they will be absent from the market as buyers. If this coincides with any softening in speculative demand, the lack of industrial buying could accelerate a correction. Then, there's the economic growth question. Industrial demand assumes continued global expansion. AI deployment assumes corporate tech spending remains robust. Solar installations assume government subsidies and energy transition budgets continue. If economic growth slows in 2026, all these assumptions come under pressure. The semiconductor industry provides a useful analogy. In 2021 and 2022, chip shortages drove frantic buying. Prices spiked, companies paid premiums to secure supply. Then demand normalized. Inventory corrections followed. Prices collapsed. The same boom-bust cycle affects any industrial commodity when speculation overtakes fundamentals. For silver, the industrial narrative is real, but the price may have already overshot fundamentals. The market is pricing in sustained high growth in AI, solar, and EV adoption. It's assuming no substitution despite high prices, and is ignoring the inevitable inventory cycle. Those are significant assumptions to make at all-time high valuations. The risk for investors is clear. Industrial demand provides a floor under silver prices, but that floor is probably somewhere between $30 and $40, not $80. The difference between current prices and fundamental industrial value is speculation. While speculation can persist, but it can also unwind rapidly when narrative changes. Industrial demand is the floor, but the de-dollarization narrative is the ceiling. Let's look at the climax of this story. The de-dollarization story has become the emotional center of the current silver rally. It's the narrative that ties together geopolitical tension, monetary policy, and precious metal demand into a single, compelling thesis. It's also the narrative most vulnerable to reality. The base argument is straightforward. Central banks are losing confidence in dollar-based assets. They are diversifying reserves into alternatives. Gold purchases have exceeded 1,000 tons annually for 3 consecutive years. Silver benefits by association. As faith in fiat currency erodes, hard assets appreciates. The data supporting this narrative is real. The BRICS nations have been particularly aggressive gold buyers. Russia and China have reduced dollar reserve holdings. These are facts, not speculation. The question is, what they actually mean for silver prices. Let's examine the respectivity. Central banks buy gold, not silver. Silver isn't classified as a reserve asset under international banking standards. Central banks hold roughly 35,000 tons of gold. They hold virtually 0 tons of silver. So the connection between de-dollarization and silver demand is indirect at best. The market's logic runs through retail investors. As central banks buy gold, retail investors see the move as validation of the precious metals thesis. Unable to afford meaningful gold positions, they buy silver instead. The retail buying drives silver prices. It's a second-order effect based on narrative, not direct institutional flows. Here's where the timing becomes critical. The most aggressive central bank gold buying occurred in 2002 and 2003. Silver barely moved during that period. It wasn't until late 2024 that silver began outperforming. What changed wasn't central bank behavior. What changed was retail sentiment and speculative positioning. The SWIFT payment data reveals the gap between narrative and reality. The US dollar still accounts for 59% of global payment flows. That's down from 63% 5 years ago, but it's hardly a collapse. The decline is gradual. The narrative suggests imminent dollar replacement. The data shows incremental adjustment. This creates what market participants call a duration mismatch. The structural shift away from dollar dominance is real, but it's a decade-long process, not a quarterly event. Investors buying silver at $80 are pricing in rapid de-dollarization. They're betting on acceleration of a trend that's actually quite slow. There's also a logical problem. If de-dollarization were truly accelerating, we'd expect to see dollar weakness. Instead, the dollar index has been remarkably stable. For a currency supposed in terminal decline, that's impressive resilience. The explanation lies in alternatives. De-dollarization requires alternatives. What currency replaces dollar for international trade? The euro has its own structural problems. The yuan isn't freely convertible. No other currency has the depth and liquidity to serve a global reserve. Gold can serve as a reserve asset. That's why central banks buy it. But gold isn't useful for trade finance or corporate transactions. You can't run the global economy on gold settlement. So while central banks diversify reserves, the operational currency system remains dollar-based. Silver benefits from neither reserves nor payments. The climate of this narrative comes from where investors realize the timing mismatch. De-dollarization is real as a multi-decade trend, but it doesn't justify silver at $80 in early 2026. The price is embedding expectations of immediate systematic change that isn't occurring. History shows how this resolves. In 2009 through 2011, similar narratives drove silver from $10 to $50. The stories were currency debasement from quantitative easing, Chinese economic dominance, and dollar collapse. All those trends were real, but the timing was wrong. Silver collapsed back to $26 within months. The current situation has the same structure. Real trends, compressed time frames, speculative excess. The de-dollarization narrative is the emotional fuel driving the final phase of the rally. It's the story that allows investors to ignore valuation and embrace hope. That's why it represents the climax. When narratives reach maximum emotional intensity, they're usually near exhaustion. The de-dollarization story is now mainstream. It's in financial media and on YouTube daily. Retail investors cite it reflexively. That level of narrative saturation typically precedes reversal, not acceleration. For sophisticated investors, this is the signal. When the crowd embraces a narrative completely, the trade is over. The last buyers have bought. Distribution can begin. The Wyckoff operator uses maximum narrative intensity to offload positions at optimal prices. We are likely at exactly that moment. History doesn't repeat, but it often rhymes. Silver has experienced 2 previous parabolic rallies in modern history. Understanding how they ended provides essential context for evaluating current risk. The 1980 rally remains legendary. Silver entered 1979 at $6 per ounce. By January 1980, it peaked at $50. That's a more than 8-fold increase in 12 months. The Hunt brothers' attempt corner of the silver market drove the final surge. Then it collapsed. The mechanism of collapse was regulatory. The COMEX exchange implemented Rule 7. This rule restricted traders to liquidation-only positions. No new buying was permitted, only selling. Retail investors who bought at $40 or $50 believing the rally would continue to $100 were annihilated. Many were using leverage. The forced liquidations cascaded. Margin calls went unmet. Accounts were wiped out. The effect was immediate and catastrophic. Silver dropped from $50 to $11 in just 8 weeks, a 78% decline. The regulatory change didn't just end the rally, it reversed it violently. The 11/2000 episode followed a different path but ended similarly. Silver rallied from $8 in 2008 to $49 in April 2011. The narrative was quantitative easing and currency debasement. The Federal Reserve's balance sheet expansion convinced investors that inflation would spiral out of control. The peak came after several CME margin requirement increases. Just like December 2025, the exchange raised margins 5 times in 2 weeks. This forced leveraged traders to either post more capital or exit. Most couldn't post capital. The selling pressure began. Then the Federal Reserve signaled confidence in the recovery and hinted at tapering asset purchases. That shifted the narrative. Dollar strength returned. Silver collapsed from $49 to $26 in 10 weeks, a 47% decline. Both historical episodes share common features with today. Parabolic price action, mainstream media coverage, retail investor FOMO, margin requirement increases, and narratives that seemed unsaleable at the peak. The emotional structure is identical. But there are also important differences. The 1980 rally was driven by a manipulation attempt, not genuine demand. The 2011 rally was purely speculative, anticipating inflation that never materialized. Today's rally has industrial demand growth, actual supply deficits, and geopolitical supply disruption. These are real factors. They provide support that didn't exist in 1980 or 2011. A correction from current levels probably doesn't return to pre-rally prices because the fundamentals are different. The industrial demand base is critical. In 1980, industrial silver consumption was growing slowly. In 2011, it was stagnant. Today, AI and solar are driving genuine consumption increases. This creates a floor under prices that's structurally higher than in previous cycles. The supply deficit matters too. In both 1980 and 2011, silver had been in surplus for years before the rally. Inventory was ample. When prices spiked, producers could respond with additional supply. Today, we're 5 years into structural deficits. The supply response will be slower. China's strategic resources designation is also new. In neither 1980 nor 2011 did a major producer restrict exports. This fragmentation of physical markets creates different dynamics. Even if paper silver corrects sharply, physical premiums might persist longer than in previous cycles. However, these differences don't eliminate the risk. They change the magnitude of potential decline, not the direction. Instead of a 70 to 80% collapse like 1980 and 2011, the current rally might see a 40 to 50% correction. That's still catastrophic for late buyers. Consider the mathematics. If silver corrects 50% from $80, it trades at $40. That's still above the 2024 average of $28. Fundamentally justified. But for someone who bought at $80, that's a devastating loss. The fact that it's not as bad as 1980 offers little consolation. The regulatory risk remains. Exchanges can change rules at any time. The CME already raised margins in December. If volatility continues, they could raise them again. They could implement position limits, they could restrict certain types of trading. Rule changes don't require warning or justification. The Federal Reserve's role deserves attention. In both 1980 and 2011, Fed policy shifts marked the turning point. In 1980, Paul Volcker raised rates aggressively to combat inflation. In 2011, the Fed signaled the end of emergency stimulus. Today, if the Fed pauses rate cuts or signals concern about inflation, the narrative shifts. Markets have priced in a Goldilocks scenario, not too hot, not too cold, just right for precious metals. Reality rarely cooperates with Goldilocks. The lesson from history isn't that silver will definitely collapse. It's that the parabolic rallies create extreme fragility. Small changes in narrative, policy, or regulation can trigger disproportionate price moves. Investors who don't understand this fragility confuse bull market confidence with safety. For those considering entry at current levels, history suggests the risk-reward is deeply unfavorable. You're buying after the bulk of the move has occurred. You're buying when narratives are at maximum intensity. and you're buying with historical precedents showing that this is precisely when risk is highest, not lowest. We know where we've been. Now, let's calculate where silver actually belongs. After extreme volatility, markets eventually discover fair value. That process can take months, but having a mathematical framework for where equilibrium might settle is essential for managing positions and evaluating risk. Analysts have developed a reasonable approach to estimating silver's fundamental value. The methodology is imperfect, but it provides a rational anchor. The calculation starts with production costs, adds incentive margins, and includes a scarcity premium. Current all-in sustaining costs for primary silver mining average approximately $18 per ounce. That's the base. Below this price, mines shut down. Supply contracts. This creates a hard floor under the long-term price. The market can trade below production costs temporarily, but not sustainably. The incentive margin is the return required to bring new capacity online. Mining is capital intensive. Projects take 7 to 10 years from discovery to production. Investors won't fund new mines unless they expect returns above the cost of capital. That incentive margin is currently estimated at $27. At production costs and incentive margins, we get $45 per ounce. That is the price required to maintain adequate supply over the medium term. It's not the market price. It's the equilibrium price that balances supply and demand without speculative premium. The scarcity premium reflects the structural deficit. With 5 years of undersupply and limited new mine development, silver trades above pure production economics. Analysts estimate this premium at approximately $10 per ounce. It reflects genuine supply tightness, not speculation. Combining these components produces a fair value estimate of $55 per ounce. This is the price that accounts for production costs, investment incentives, and structural scarcity without embedding speculative excess or narrative-driven premiums. Current prices of $80 imply a $25 speculative premium above the fundamental fair value. That premium represents momentum, FOMO, De-Dollarization narratives, and Wyckoff markup phase buying. It's the part of the price most vulnerable to reversal. This framework suggests a correction to $55 would be mathematically rational. It wouldn't represent capitulation or crisis. It would simply represent the unwinding of speculative excess while maintaining prices above historical norms. The question is whether the return to fair value happens gradually over 12 months or violently over 12 weeks. Historical patterns suggest volatility. Silver doesn't trend smoothly. It gaps. In 2011, the move from $49 to $26 took 10 weeks. If current prices are 50% above fair value, a similar velocity decline would reach $55 by March or April. This doesn't mean investors should time the exact top. It means understanding where value lies. At $80, you're buying 50% speculation. At $60, 10% speculation. At $55, you're largely buying fundamentals. The risk-reward changes dramatically at each level. For active traders, the fair value framework provides targets for scaling in. Rather than buying at current levels, waiting for a correction towards $60 reduces risk substantially. Waiting for $55 eliminates speculative premium almost entirely. For existing holders who bought below $40, fair value analysis suggests taking profits. You've captured the fundamental repricing. The additional $25 from $55 to $80 is speculation. Professionals' practice is to lock in fundamental gains and let speculation run with reduced position sizes. The industrial demand trajectory will influence fair value going forward. If AI and solar growth continues, the scarcity premium might expand from $10 to $15. That would push fair value to $60. But that's a future adjustment, not current reality. Exchange-traded funds flows provide early warning signals. When silver ETFs showing sustained outflows, It suggests institutional investors are reducing exposure. That's typically a precursor to price weakness. Watching weekly flow data helps anticipate corrections before they fully develop. The dollar's direction matters. Fair value analysis assumes relatively stable currency markets. If the dollar strengthens significantly, it puts downward pressure on all commodity prices, including silver. Fair value might compress toward $55 in a strong dollar environment. These aren't predictions. They are frameworks for decision making. Markets don't move in straight lines, but having reference points for value helps distinguish opportunity from risk. At current prices, the math suggests more risk than opportunity. The math is clear, but how do we manage a position in a market that's volatile? The silver market in early 2026 represents a clear case of late-stage past speculation layered on top of genuine fundamental improvement. Separating these components is essential for rational position management. The fundamentals are real. Industrial demand growth is structural. Supply deficits persist. Geopolitical fragmentation has created physical market tightness. These factors support significantly higher prices than the $20 to $30 range that prevailed from 2020 through 2024. But the prices has overshot fundamentals. At $80, silver embeds speculative assumptions about accelerating de-dollarization, continued Wyckoff markup phase buying, and absence of demand destruction. Those assumptions are fragile. Small narrative shifts can trigger significant unwinding. For investors considering new positions, the risk-reward is unfavorable. You're buying after a 190% rally. Technical indicators show extreme overbought conditions. Historical precedents suggest late-stage parabolic moves end badly for recent entrants. The margin trap is real. Exchanges have already raised requirements once. They can do it again. Leveraged positions face forced liquidation risk that has nothing to do with market direction. This is structural risk that many retail investors don't fully understand. The divergence between paper and physical prices creates separate risk profiles. Paper silver through ETFs offer liquidity but counterparty exposure. Physical silver eliminates counterparty risk but locks in massive premiums that will likely evaporate during any correction. For those buying paper silver through ETFs, the advantage is liquidity. You can exit quickly if the technical picture deteriorates, but you're exposed to institutional flows. When large holders decide to reduce exposure, ETFs can see sustained selling pressure that accelerates declines. Physical silver buyers face different mathematics. Paying 85% premiums means you need silver to reach $140 just to break even with someone who bought paper at $80 and converts to physical later. That's not hedging, that's speculative on systematic collapse. Are you an investor or a speculator? An investor buys when the chart is quiet and the narrative is dead. A speculator buys the vertical line. Which one are you today? Here's what professionals would do if they accumulated below $40. Tiered exits. The concept is straightforward. When an investment doubles, sell through to recover your initial capital. Now, playing with house money. Let the remaining position run with a trailing stop. This approach eliminates emotional decision making. You have locked in a win. Whether silver goes to 100 or back to 50 doesn't determine success. You're protected either way. The remaining position captures additional upside if the rally continues without risking realized gains. Position sizings remain critical. Even for long-term believers in silver's fundamental case, concentration risk is dangerous. Professional practice limits any single commodity exposure to 5 to 10% of total portfolio. This prevents catastrophic outcomes from single position mistakes. The correlation with other assets matters. Silver tends to move with risk assets during growth periods and with safe havens during crisis periods. This dual personality makes it a poor diversifier. Including silver shouldn't come at the expense of truly uncorrelated positions. The strategic question is timing. Very few investors can call exact tops, but waiting for a better entry point is rational risk management. This isn't advice to never buy silver. It's recognition that price matters. The asset can be fundamentally sound when the valuation is extended. Patience allows you to capture the fundamental story without paying for peak speculation. The broader lesson transcends silver. Every asset goes through cycles: accumulation, markup, distribution, decline. Understanding which phase we are entering is more important than understanding the asset itself. At $80, silver is in distribution. That's not opinion, that's pattern recognition. The FOMO impulse is natural. Watching an asset double creates urgency. The fear of missing additional gains overwhelms rational analysis. But late-stage entry has predictable outcomes. Small gains if you're lucky, significant losses if you're not. The mathematics don't favor chasing parabolic moves. Professional practice means building positions during accumulation, adding during early markup, trimming during late markup, and exiting during distribution. We are in distribution. The professional move is selling, not buying. Retail investors do the opposite. That's why returns diverge. The resolution is clarity. Silver offers genuine long-term value, but not at any price, not at any time. The current price and current market structure suggest elevated risk. Markets provide opportunities across cycles. Missing one entry point creates space for the next. Capital preservation allows participation in future opportunities. Losing capital chasing parabolic tops eliminates that optionality. The final principle is honesty. If you're buying silver at $80, acknowledge you are speculating on continued mania. That's acceptable if you size the position appropriately and maintain straight stops. But don't confuse speculation with investment. The distinction determines outcomes. At Asset Tech, we don't follow the crowd, we follow the data. Stay disciplined and never ever FOMO into a vertical line. If you agree to this, it's time to subscribe now. Thank you.